applied the 75% rule. And the recent finance bill of 2023, I searched online. It says that the 75% rule does not apply. So I don't know how we go about that.
I will talk about it in the next one. There's another question that we have. Particularly for those questions, when you look at for those questions, in most cases, you will not have a scenario where you don't tax them. You see, if you have even a scenario that you don't tax them, you can never have a scenario that you don't tax them. So I will talk about it based on that finance bill. So that is the next class. There's one more question that I'm doing there. Is that okay, Clinton? Clinton, respond with a yes. Okay. So I want us to start on send the August paper. Send the August paper. Send the August paper. Send the August paper. Has the paper been forwarded? Oko and Victor forwarded the past paper. So past paper having August. I want everybody to have the papers. Kindly, whoever, the paper is in the group somewhere, somebody just to. Send that kindly. Send the paper. No, August 2025. The paper shared does not have that. Does it have that? Somebody says the paper has been shared. I can't see it. I can't seem to see it. We are taking a lot of time. Can somebody just take over and send the paper? No. So let's look at the first question. That is question 1. So I've been told that you have been appointed as a tax advisor. That is okay. You have been appointed as a tax advisor. And you're saying to a contractor involved in infrastructure project for a county government. The government has recently received a conflicting assessment from both the Revenue Authority relating to a withholding tax and county government relating to contractual service levy. The contractor believes the charges are duplicative and not grounded in clear provision. The delays in resolving the disputes have stalled payment and strained what you call the contractor's cash flow. So, number 1, explain tax dispute resolution mechanism available to contractor under Kenyan law. Tax dispute mechanism. We have it, 1, tax dispute. Tax disputes mechanism. We say available to a contractor, and call it under what you call the Kenyan law. Under the Kenyan law. So, what are some of the dispute mechanisms? that are available to the contractor under the Kenyan law. So what are dispute resolution mechanisms that we are saying are available to the contractor under the Kenyan law? So what are the dispute resolution mechanisms that are available to the contractor under the Kenyan law? So one of the dispute resolution mechanisms that is available to this contractor is objection process with KRA. So one is what's called the objection. The first one is what's called objection process with the Kenya Revenue Authority. Together, team. Objection process with the Kenya Revenue Authority together. So this is basically entails what we call filing a notice of objection. Filing what we call a notice of what we call of objection. Filing what we call a notice of what we call objection. Filing a notice of objection. Are we together? Filing a notice of objection. Are we together? That is basically, you don't need to know this section. That is section 51 of the Tax Procedure Act. That should be section 51. 51 of what we call of the Tax Procedure Act. Although this is not required. When this, most of the students may never know what this is together. So you need to file a notice of objection. This is provided under section 51 of the Tax Procedure Act together. So this should be done within, the teacher have said, filing objection process with the Kenya Revenue Authority. And then you say filing a notice of objection. This is provided in section 51 of the Tax Procedure Act. But majority of the students will not get deeper into this. So just, once you notice that objection process with KRA, you just need to say filing a notice of objection, and this should be done within 30 days of receiving the assessment. So we call it within 30 days of what we call of receiving what we call the assessment. Within the 30 days of receiving what we call the assessment together. Within 30 days of receiving what we call the assessment. Within 30 days of receiving what we call the assessment together. Within 30 days of receiving the assessment. Within 30 days of receiving the assessment together. So that is tax resolution mechanism, tax dispute resolution mechanism. Is that understood? Do we have this in the notes? Yes, we have altogether. And the taxman has about 60 days to reply to get back to you altogether. The taxman has 6 days to reply back to you. So the marking point is not the most objection we carry. This is the marking point. So say we have the next alternative dispute resolution method. The next will be alternative. Call it alternative. And we call it dispute resolution mechanisms. What is this? This is ADR. Together. That is ADR. That you can just move from the commission and just go to the ADR together. So ADR, what is the difference between objection in the court and the ADR? ADR. Engage ADR with KRA. ADR with KRA. So remember the establishment of the ADR, we basically said what led to the establishment of ADR? To allow for more compliance, to allow for what's called more compliance in terms of tax relations altogether, to allow for more compliance. Because cases were taking long, so the idea of coming up with a array was to allow for more compliance altogether. You need to understand that ADR are voluntary and time bound. The voluntary, what you need to voluntary, and say and what you call time time bound. So they are voluntary, and you say they are time bound, facilitated by KRA and ADR unit. These are facilitated by KRA and ADR unit. Have these things been taught? Have these things been taught? That is the second. How many marks was that question? How many marks was that question? 4 marks. So you didn't even need to explain a lot. So we have TAT, which is a tax appeal tribunal. We have the TAT, which is tax appeal tribunal. We have what's called tax appeal tribunal. That is called TAT, tax appeal tribunal. We have what's called the tax appeal tribunal. We have what's called the tax appeal tribunal altogether. So if you fail to agree, look at if objection with the commissioner, you fail to agree with the commissioner, you can go to this, or if ADR fails, you can go to the tax appeal tribunal altogether. If you're dissatisfied with the charge or with the commissioner, you can escalate it. Dissatisfied with what's called the commissioner, or if you went to the ADR and you're not, you can proceed. If you're dissatisfied with that, you can escalate it altogether. If you're dissatisfied with the commissioner, mostly dissatisfied with the commissioner, you can take it to the tax tribunal altogether. Again, for the tax tribunal, again, you need to understand that within 30 days of objection. Within 30 days of objection. This is within 30 days. 30 days, we say, of what we call of objection. Within 30 days of what we call objection. We have it within 30 days of objection. Within 30 days of objection. Within 30 days of objection. Within 30 days of what we call of objection. Together. Are we together? So the other form of appeal, you can go to the High Court altogether. Judicial review, or what you call the High Court. Call it judicial review. Reviews to what you call the High Court. To what you call the High Court. Judicial review, to what you call the High Court. Judicial review, to what you call the High Court. Judicial reviews to what you call the High Court altogether. So again, remember this is a process. So again, if you're dissatisfied, we say dissatisfied. Now you're dissatisfied with tax appeal tribunal. If you're dissatisfied with the tax appeal tribunal, you can go to the High Court. You can go to the High Court altogether. Are we together? To seek court opinion. So that is the next is judicial reviews to what you call appeal in there. Appeal to the High Court altogether. This is judicial review or appeal to the High Court. Together. That's the next. Are we together? Are we together? But remember, you had issues with the counties. So for issues that they had with the counties, how do they address those issues that basically they have with the counties? So for those counties, you can have what's called internal administration. We can have what's called the internal administration. We call them the internal administration. So for the internal administration, we know that this is for the county taxes. For the county taxes. When it has issues with the counties, those is internal administration. Are we together? Engage on the county with the county legal team. On internal resolutions. Is that question sorted perfectly right? Is there anybody with a question concerning that? Yoswali Kosawa, has it been done? If that question has been done, then you give it a yes. Perfect. So the next the last I've said internal administration. Yes, you can deal with internal administration. That is for the county taxes. You can engage the internal administration. That is for the county taxes. Together for the county taxes. That is for the county taxes. You can engage internal administration to solve issues to do with the taxes. So, if we are together, we respond with a yes. So the next question, we're being asked on that particular question, again on that. Advise the contractors on steps to take in resolving tax dispute. Steps to take, call it steps to do what you take in resolving what you call the tax dispute, in resolving what you call the tax disputes, in resolving what's called the tax disputes, in resolving the tax dispute with the KRA. So how would, for example, how would you KRA and county government? And I think that this is where we lose it practically. Somebody will say, I know a guy in KRA. Is that the best way to solve dispute? When you have a tax dispute, Clinton with Kenya Revenue Authority, and you tell them that you have a guy, somebody in KRA. Is that the way to solve this dispute? What would be the prudent way to solve? You have identified this is the procedure. This is where mechanisms are available for you. How do you solve disputes with the Kenya Revenue Authority? How do we solve disputes with the Kenya Revenue Authority? How would you solve disputes with the Kenya Revenue Authority? How would you solve disputes with Kenya Revenue Authority? Are you going to say that you know a guy in KRA? So you decide. We've talked about mechanism that we use, but how do we now practically sort these issues? How do we practically now sort these issues? So when you have those issues, one of the most practical way that you go about it is to gather. You see, remember you have a 30 days period. So one of the best ways that you're going to solve it is to gather what? One is to gather relevant documents. Are we together? Are we together? So one of the best ways to gather, would be to gather all relevant documents. Would be to gather what you call all relevant document. Would be basically to gather all relevant documents altogether. Don't say that you know a KRA guy, but you say that you gather all relevant documents altogether. So if it's documents, invoices, gather those invoices. If it's tax assessment altogether, if it's correspondence, gather those documents altogether as a step to solve altogether. Steps that you're taking, not procedure, but the steps altogether. Another step would be to file an objection. Are we together? File an objection. Are we together? File an objection. We can have file what we call an objection. File what you call an objection with what's called with the KRA, and we have the county file an objection. Don't keep quiet and say I know somebody, but now gather the evidence and file the objection. You don't just file an objection, but you're filing an objection on the basis of what? On the basis of the documentation that you have. Are we together? What would you do as a tax personnel too? What are you going to do? We say file an objection. What are you after an objection? What are you going to do as a step? What are you going to do as what are you going to do? What are you going to do after filing that objection? What are you going to do after filing that objection? So the first prudent thing would be to gather evidence. Don't say that you know a KRA. Gather your evidence perfectly well, and then file an objection. Again, you can also seek clarification on legal basis. You can also seek clarification, seek what you call seek clarification on what you call on the legal basis. On the legal basis. Seek clarification on what you call on the legal basis. Seeking what you call clarification on the legal basis altogether. But again, when you find it's an issue that is that you can resolve so easily, would you want to go through the court? Would you want to go to the court? If it's an issue that is so easy, you can just engage what you call ADR. You can engage what you call the ADR. If it's an issue that is simple, you can basically engage ADR. Again, if it's an issue that's required, you can also consider what you call litigate. You can talk about consider what you call litigation. Consider litigation where necessary. Where necessary. So these are the steps that you take in resolving a dispute. In resolving a dispute. Is that satisfactory, sir? Done. If you have a question, you ask. Together. Are we together? Is that sorted? If that is sorted, we'll respond with yes. So the next would be institutional reforms that can be adopted, that can be implemented to avoid similar disputes. So institutional reforms, we talk about institutional. We call it reforms that can be adopted. Let's say can be adopted to avoid a similar disputes. To avoid what's called the similar disputes. To avoid what's called similar disputes. So institutional reforms that can basically be adopted to avoid what we call similar disputes. What can be adopted to avoid these disputes in the future? What are these reforms that can be adopted to avoid those? To avoid similar dispute. To avoid that, what are these reforms that can be introduced to them? What can be done to avoid this in the future? Compliance in relation to what? Yes, compliance is good, but expand it. We can automate tax administration. We can talk about automate tax administration. You can automate tax administration. And the essence of this is to provide what we call transparency. Digital system, we call it digital systems. We say digital system to improve what we call transparency, to improve transparency, and track, and they're able to track assessment, and be able to track assessment and what we call payment, and be able to attract assessment and what we call payment, and be in a position to attract assessment and what we call payment together. So automate the system, but you can also talk introduce what we call introduce. We can talk about introduce what we call taxpayer service charter, taxpayers service charter, taxpayers service charter out here. So that should be basically define what we call timeline. This should basically define what we call timeline and procedures procedures for resolving disputes, resolving disputes altogether. So come up with, introduce what you call a taxpayer service charter. Taxpayer service charter. That is basically to define what you call the timelines and procedures for resolving what you call disputes altogether. Then we can also establish what you call interagency. We say establish what we call interagency. We can talk about establishing what's called interagency, MOUs with KRA. Interagency, MOUs with KRA. That is basically to clarify. This is to clarify what we call the tax rules. To clarify the tax rules, data sharing, and what? And judicial boundaries. Together, that's the next way to solve that. How would you minimize? Apart from those three, how would you minimize? Again, some issues are emanating from county staff. So train county staff on the tax laws. You can also engage train county staff on what's called on the tax laws together. Do you believe that in the county and even a KRA itself, majority of them do not understand the tax law? Do you believe on that? Do you believe that majority do not still understand the tax law? So you should train county staff on the tax laws as a way of resolving to minimize that in the future. We do not have that altogether in handling dispute altogether. So, and lastly, we can talk about harmonization. We have harmonization, county, what we call the county tax policy. Harmonize county tax policies. Align it with the constitution. Align them. Not just say align it with the constitution. Align it to the constitution. Align that with the constitution. Align it with the constitution. So there's a way that you ensure that you minimize those disputes. Those are the reforms that you can basically take to minimize dispute together. Is that question one satisfactorily sorted? Harmonization of county tax policy. Yes. So the next question, we check the next question. The next question. Treaty policies, what all treaty policies are central in shaping a country's external tax relation, are essential in shaping a country's tax relation, facilitating trade and investment, and ultimately fostering what we call economic cooperation. However, the implementation is subject to hurdles which are subject to hurdles which affect realization of their objective. Then you're being told required. Evaluate for structural hindrance to implementation of tax. Evaluate what we call four structural endurance to what we call to implementation of tax policy, the implementation of the tax policies in your country. So evaluate what we call four structural endurance to what I call four structural endurance to the implementation of tax policy in your country. In your countries. So we talked about this. Did we talk about this? So what are those structural that are endurance to the implementation of tax policies? Structural endurance to the implementation of tax policy. What are these endurance? Endurance to the implementation of tax policy in your country. Like in Kenya. So in Kenya, what are those challenges? These policies, why do we face these challenges? So what is the first reason, hindrance to this? So the first hindrance, if you look, is lack of funding. Call it lack of funding and infrastructural constraint, and what you call an infrastructure constraint. So that is the first altogether. Kenya being a developing country, we understand lack of funding and infrastructure constraint altogether. To support what? This to support what we call training. To support what we call the training. To support training, technology, and system. To support training, technology, and what we call the system. Is that true? So this tax policy, why did they fail altogether? Structural hindrance to the implementation of the tax policy, we understand is lack of funding and what we call infrastructure constraint. We must agree that, and these are required to support what we call training, technology, and the system. That is one of the first hindrance altogether. Are we together? That is the first hindrance. Is that true? Kenya being one of the countries. Is that true? Supporting this tax policy, implementation of tax policy. Funding is a key thing, and infrastructure is also a key thing altogether. That is something that we have mismanagement in domestic, mismanagement, what we call mismanagement. We have what's called mismanagement between domestic tax laws, between what's called the domestic tax laws. So what they call the mismanagement between the domestic tax law and international, what they call the international treaty obligation. So mismanagement between the domestic tax laws and international treaty, hence leading to conflict, and hence leading to what we call conflict, hence leading to conflict, what we call conflict, and what we call implementation delay, hence leading to what we call conflict and implementation delay together, hence leading to what we call the conflict and what we call implementation delay together. That is the second structural hindrance to implementation of tax policies. We talked about mismanagement between the tax law and international treaty obligation, hence leading to what's called I am breaking. Are others everybody facing the same challenge? Somebody says, Monimo, I am breaking. Is it my net? Is my net stable? Kindly confirm if my net is okay. Are you able to see the board clearly? Yes. Am I breaking or everything is okay? Am I breaking or everything is okay? Is everything okay? Give me yes if everything is okay. If everything is okay, you give me yes. Yes. So check. So check. Either says yes. So we can talk about the next lack of adequate capacity. So these policies also require lack of adequate, lack of what we call of adequate. We call it adequate. I can turn like this: adequate capacity from what we call from the revenue, adequate capacity from the revenue authority, and what we call and other institution. So what we call lack of adequate capacity from the revenue authority and other institution to monitor and put to action and say and enforce what we call the tax treaty So basically saying that the lack of adequate capacity from the revenue authority and other institution to monitor and enforce tax treaty that leads to hindrance altogether on implementation of these policies together. Are we together? Are we together? Lack of capacity. You can have a policy, but you do not have the power. Then lack of digital. If you look at Kenya, the lack of what we call digital and system for monitoring and what we call system, and we call it for monitoring. Lack of what we call digital and the system of monitoring, what we call cross-border transactions. So, of cross-border transactions and ensuring treaty compliance and ensuring what we call treaty compliance. So the fourth interest to implementation of a policy in your country, and Kenya being our country, we know that lack of digital and system for monitoring cross-border transaction and ensuring what we call that there is compliance together. That is the structural interest in implementation of a tax policy in your country. Together, team. Is that understood? If that is understood, we give it a yes. If that is understood, we give it a yes. Perfect. So the next question, the next theory question for that particular year, the next theory question, 3A. Let's look at the 3A. So 3A, the examiner tells us, as a regional trade consultant working with East African community, that is EAC Secretariat, explain 4 ways on how implementation of one-stop border post, OSBPS, have contributed to the growth of regional trade in East Africa. Have contributed to the growth of trade in East Africa. Have contributed to trade in East Africa? That should be a much simpler question. How have they contributed to trade in East Africa? So we have OSPS have contributed to what they call to trade in what they call in East Africa. How they have contributed to trade in East Africa. One-stop border. How has it contributed to trade? Because that should be a much simpler. How has it contributed to trade? How has it basically contributed to trade? How has it contributed to trade? How has it basically contributed to trade? How has it contributed to trade? One-stop border shop. So when you have one border stop shop, how has it contributed? Ease of flow. Somebody says ease of flow. Somebody says ease of flow. So if Kenya has this checking here, Tanzania also has checking on the border this and this, what will happen? In terms of clearance time, if you don't have one-stop border post, in terms of clearance time, how will it be in terms of clearance time? In terms of what we call the clearance time. In terms of what we call the clearance time. In terms of what we call the clearance time. You'll take longer to clear altogether. With one-stop border post, there's reduction in clearance time, tedious altogether. Reduction in clearance time and trade delay. Reduction. So we have reduction in what we call clearance time. And what we call delays. So reduction of clearance times and delays in trade are which together. Yes, there's harmonization on two or several countries. Yes, faster and more effective altogether. Lower the cost of doing business altogether. It does again lower the cost of doing. Lowers what they call the cost of what they call of doing business. This will lower the cost of doing business. Is that true? It will lower the cost of doing business. If it's not harmonized, if this is because this one's harmonized, you basically harmonize the rates of tariffs that are being charged. So in the end, it does lower what you call the cost of doing business altogether, consolidated altogether, product transport altogether. So then you have promotion of regional value chain, promotion of regional value chain, promotion, call it promotion of regional value, we call it chain. So it promotes regional value chain altogether. Regional value chain, what you call regional value chain. It promotes regional value chain altogether. Regional value chain altogether. Enhance revenue collection and transparency. There's transparency. Enhances what you call revenue collection, and what you call transparency. So it does what? It enhances what we call revenue collection. It enhances revenue collection altogether. Revenue collection, but at the same time, there's a lot of transparency at the border altogether. But again, also it improves what we call security and risk management altogether. Joint border operation improves what we call security and what we call the risk management. It improves what we call improve security and risk management together. So we understand with that, the joint border enable what we call better control altogether. A joint border enable better control of illegal goods. So that's why we say it improves what we call security and risk management altogether. Joint control of illegal movement of illegal goods or human trafficking altogether, or anything that is of security of threat when you have a joint border control. So if you ask one stop border post, one, it reduces what we call clearance and time and delays in trade. We say it lowers the cost of doing business because these tariffs are harmonized. We know that promotion of regional value chain, then we have enhanced revenue collection, and there's a lot of transparency. Last, we have talked about improved security and what's called the risk management together. So that this is the benefit of one border stop shop together too. We give it a yes if we are together. If we are together, we give it a yes. Perfect. This moves so fast. So we can introduce the next question before we take a small break, again, a break of 10 minutes, and we come back, finish. So the next question is on what? Yes, there's a lot of theory in this. So question 4A. So we can cover that A, then take a small break. We take a small 10-minute break. So it talks about question 4A. During a tax seminar on mitigating tax exposure, the keynote speaker observed that tax risk management plays a critical role in the development of tax planning strategy of an organization. Summarize 4 ways that a tax professional could use to quantify tax risk in an organization. How would you quantify tax risk in an organization as a tax professional? How would you quantify it? So there's 3C. Somebody says, are we skipped? Which is which? Is it 4A or 3C? Let me check 3C. There's no 3C. I don't think so. 3B, sure. 3B is look at that 3B. 3B is a question. 3B is a question. Oh, Roman 3. So we talked about this. We talked about it, didn't we, in class? We talked about it. Obligation for a mining company, didn't we? So number 1 is payment of corporation tax at 30%. We talked about that. Payment of corporation tax. Are we together? Did you talk about that, Ngetich? Obligation for mining. We talked about corporation taxes, and we talked about remittance of withholding taxes altogether. Are we together? On payment to professionals altogether. Ngetich, is that sorted? I've said payment of corporation tax as a tax obligation, and we talked about withholding for professionals altogether. For professional, are we together? For professional. Yes. So that's okay. Corporation tax and the withholding tax together. And you teach and the team, can you respond? Thank you, Lan. So we were on ways of quantifying what's called the tax risk. Ways of quantifying what we call the tax risk. So we can take a small break and start it from there. We can have our small break of 10 minutes and we come back. That's okay. Are we there? If you're there, we respond to yes. If we are there, then we respond to yes. If you're there, then we respond to yes. Give me a yes if you're there. So ways of quantifying. Let me just open the question again. Tax groups. We'll just read the question again before we answer that question. So summarize 4 ways as a tax professional could use to quantify tax risk in an organization. How would you quantify tax risk in an organization? How would you quantify tax risk in an organization? How would you quantify what they call the tax risk in an organization? How would you quantify the tax risk in an organization? How would you quantify? How would you quantify the tax risk in an organization? As a tax practitioner, how would you quantify? So one of the ways is to use what we call past cases outcome. Use of what we call past cases. Use of what we call past cases outcome. Use of what we call the past cases outcome. Use of what we call the past cases outcome. Use of what we call the past cases outcome altogether. So if you want to quantify risk, then you look at the past cases outcomes altogether. So what does that basically mean? You review what you call legal cases and tax authority decision altogether. You review the past cases altogether to help you estimate what you call the risk of future dispute altogether. Review the past cases to help you to determine what to call the future, the chances of having future risk. That's what we call use of past cases outcome. So you review the past legal cases that they have in relation to taxes to predict what is likely to happen in the future. What is likely to happen in the future? Is that okay? So that is one of the ways to quantify risk. You review what you call the past cases outcome, so that you are able to predict what is likely to happen. Then you can have probability and impact analysis. So you can have what's called probability and what's called the impact. What you have as the impact analysis. Probability and impact analysis assessment altogether. So when you say probability, you're basically looking at the likelihood altogether of tax-related issues arising altogether. So when you say probability, you look at the likelihood of what you call the tax cases emanating. Probability, when you say probability, likelihood of the tax cases arising altogether, and estimating what you call their impact. So when you say probability, you're looking at the likelihood of these tax cases basically emanating, the likelihood of them emanating, and the impact. And you look at the financial impact, i.e., and what's called the financial, and what you have as the financial impact, and what you have as the financial impact. Financial impact, i.e., we have interest, we have interest, we have penalties. These are the impact. And you look at the impact, the financial impact. So the financial impact of this would be interest and penalties. Tuko pamoja. Is that understood? If that is understood, we give it a yes. Number two, when we talk about probability, that is the likelihood, and the impact touches on penalties and interest. So then we have what's called scenarios analysis. The professional can come up with what's called a scenario. What it calls scenario. Call it scenario. Scenario analysis. What you have a scenario analysis. What you have a scenario analysis altogether. So scenario, when you say scenario, are we together? So you're using different scenes altogether, are we together, to evaluate changes in tax laws altogether. You're saying that using different scenarios, using different scenarios to do what? To evaluate. The word is to evaluate. Evaluate what's called the changes. To evaluate what's called the changes in what's called in the tax laws. Changes in the tax laws. So use different scenarios basically to evaluate, or different scenes to basically evaluate changes in what to call the tax law. To evaluate what's called the changes in the tax law. Use different scenarios to evaluate what's called changes in tax law, financial performance, and business strategy. To evaluate what's called changes in tax laws, business performance, what they call the business performance, and what's called in business strategies, and business strategies, and business strategies, and what you call the business strategy, and what you call the business strategy together. And lastly, how they evaluate risk. See, these companies are, these businesses are being done for audits altogether. Are we together? These businesses are being done for audit. So I can look at what's called the historical audit. I can basically look at the historical audit. We have what's called the historical audit. So historical audit basically provides data. This provides data for what we call for information. With information, you can basically evaluate the risk level. Are we together? So when you review what's called the past audit document, are we together? You can actually predict what's called the likelihood of this risk. Are we together? When you review what's called a past audit documents, you can actually predict the likelihood of the risk. Is that okay? You can predict the likelihood of the risk. Together. Respond with a yes. You can predict what's called the likelihood of the risk. Give me a yes if we're together. But again, one of the sure ways to do, you can also industry comparison. We can have what's called industry. We call it comparison. We call it industry comparison. We call it the industry comparison. We call it industry comparison altogether. When you look at the assessment team, whenever we are looking at the assessment on how these assessments that are being done, basically the gauge, how do they gauge? They look at the industry in terms of SME. If you're given an assessment, how do they get those figures? Based on industry. So we cannot look at tax professional can compare risk based on the industry. If it's a salon industry, they can check the risk levels altogether. Are we together? But last week, we can talk about technology. That is what we call data analytics tools. Data analytics tools. So you can use technology, and that is data analytic tools altogether. So this is what assists you. This is software. Software will assist you. Software to analyze, to basically analyze risk, to basically analyze the risk level. So software will basically assist you to analyze what's called the risk level. will assist you to analyze what you call the risk level. So software is basically coming in to assist you to analyze what you call the risk level. Give me a yes if that is done. Yes, the reason why we are doing this, we want to make sure that everything is done. We don't want to go to exam, then you say these theories we are not done. So the reason why we are doing them is to make sure that nobody complains when you go to that paper. And I said, I will revise with you. On a Monday, we are revising, just in general, we are going to revise partnership, some of the things that you need to master, like partnership on a Monday. So we'll arrange with Robert again, we'll arrange with Victor on how we are going to revise. Yes, so that when you get for tax the next day, you are reminded of what you need to do. That is answered. The next question is, the next question so you're being asked, evaluate for risk management, evaluate for roles of risk management in development of tax planning strategy. Four roles of what we call of risk, and we call it management. 4 roles of risk management in development of what we call of risk, in development of what we call risk, in development of tax planning, of what we call tax planning strategy, strategies of an organization. For roles of risk management in development of tax strategy. So what does, in coming up with the tax planning strategy, what does, how does risk assessment helps in tax strategy? How does it? So when you say risk management, how to manage, that is what's called risk mitigation of risk. So risk management is simply mitigation, how to sort risk, mitigation of what we call of risks, mitigations of what we call risk, mitigations of what we call risk. We call it the mitigation of risk. That is what we call tax risk management strategy. So how does risk management in development, roles of risk management development of a tax planning strategy? What is the role of risk management development of tax strategy? So risk management, one of the things that it does, ensuring that compliance in tax planning. Ensuring compliance in what we call in tax planning. Ensuring what we call that compliance in tax planning. Ensuring what we call compliance in tax planning. Ensuring what we call compliance in tax planning altogether. Ensuring what we call compliance altogether. Ensure that compliance in local and international tax law. So risk management will ensure that there's compliance altogether, both local and international tax law altogether. Reduce the risk of legal issues. Basically coming in to reduce what we call the risk of legal issues. So one is to ensure compliance in tax planning. Tuko sawa? Nipatie yes kama tuko pamoja. Bonyeza yes kama tuko pamoja. Bonyeza yes kama tuko pamoja. Okay. Perfect. So what is the role? So risk management mitigation. So if we're talking about risk mitigation, so tax risk management should minimize exposure to risk altogether. I see that risk mitigation, risk assessment management is also what we call mitigation of risk. Mitigations of risk is what we call mitigation of risk altogether. So the role of it in tax planning, again, is to reduce what we call exposure to risk. Optimizing tax efficiency, we call it optimizing what we call tax efficiency, optimizing what we call a tax efficiency, and minimize what we call exposure. And minimize what we call the exposure. Minimize what we call the exposure. Optimizing what we call tax efficiency, and you say minimize what we call the exposure. Minimize what we call the exposure. That's the second role I will get up. Again, what is the role? So the role of risk management is to adapt tax planning strategy, adapt what we call tax planning strategies, adapt what we call the tax planning strategies to regulatory changes, changes. If risk management, it navigates, issues that can affect. So issues that can affect together. So if it does that, then it adapts the tax planning strategy to regulatory changes by ensuring that strategies are updated, by ensuring that the 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 strategies are basically updated altogether, by ensuring that the strategies are updated altogether. Again, risk management, they can also help in promoting, we call it promoting. The word is promoting what we call transparency. Promoting what we call transparency. They can also assist in promoting what we call transparency altogether, and ethical tax planning strategy, and ethical tax planning strategy. Promoting what we call transparency and what we call an ethical tax planning strategies are together. Ethical tax planning strategy together. Protecting organizations' reputation. So this is geared to protect what we call organizations, call it reputation. Organizations' reputation, geared towards protecting what's called the organization's reputation together. Have we answered that? How many do they want? See, those are enough. Are those enough, Gital? Are those enough? Are those answers enough? I hope Clinton is there. Perfect. So the next question, what is the next question? So the next question. What is the next question? Which number? B. Let me open that. I don't have that paper. Physical paper for that. B. So in an era of evolving tax framework, self-regulation of tax professional by recognized professional body is an important component of a country's tax administration system in maintaining the integrity of the tax system. So then you're being told that analyze 4 benefits of self-regulation. Benefits of self-regulation, we call it the benefit of what we call the self-regulation. Self-regulation. Benefits of self-regulation of what we call of the tax professionals. Of the tax professionals. Regulation of the tax professional bodies. Over government oversight. Over government oversight. Self-regulation of tax professional bodies, self-regulation of tax professionals, tax professional by professional bodies, regulation, sorry, I'll note this, of tax, regulation of tax professional, by what's called by professional bodies, over government, we call it oversight, over the government oversight. What is the importance of regulation of tax professional by professional bodies over oversight by government? Professional bodies taking over government. Are we together? What is the benefit? If professional bodies does that, instead of waiting for the government to provide what's called oversight, what is the beauty of that? What is the beauty of that? Instead of government waiting for government oversight, it is fast and efficient enforcement of ethical standard. Fast and efficient enforcement of ethical standard. Fast and what we call efficient, we call it enforcement of what we call of the ethical standard. Standards. Fast and efficient enforcement of what we call the ethical standard. Fast and efficient enforcement of ethical standard. With government, there's a lot of bureaucracy. Do we agree? Are we together? There's a lot of bureaucracy. So if you allow professional bodies to do, with government, there's a lot of bureaucracy. Are we together? And administrative cost. Are we together? So if professional bodies does the regulation, we understand that those regulations are going to be fast and efficient, as opposed to government, which will reduce what we call reducing bureaucracy and administration cost. So that's the benefit of professional bodies doing what? Professional bodies, we say professional bodies regulating tax professional. Yes, I can give that increased compliance. There will be a lot of increased compliance. There's so much today increased, we call it compliance. We have what's called increased compliance. There is definitely what we call increased compliance. There is what we call increased compliance. There will be a lot of increased compliance altogether. Are we together? Increased? Are we together? So, but again, also, do you think government is professional? Are they professional? Does government focus on professionalism? Well, professional bodies focus on professionalism, focus on what we call on professionalism. So this is geared to focus on what we call professionalism. Since professional bodies emphasize on high ethical standard, focus on professionalism, since professional bodies bodies focus on high ethical standards, together. So the focus will be on not so. What do you mean by that? I'm not getting you, guitar. What do you mean by that? What do you mean by that, so that we can help? So you say focus on professionalism. Are we together? Since professional bodies emphasize on what you call professional standards and continuous training, and what you call continuous training. Together. Is that point at home? Raphael, do you have a question? Raphael, do you have a question? If you have a question, ask. Oh, it was a point. Let me read it. It's good. Okay. Again, what will be benefits of self-regulation by professional bodies? So, what is the benefit? Peer oversight and accountability is encouraged. Peer oversight and accountability. Peer oversight and accountability is encouraged. Under self-regulation. Is encouraged under self-regulation. Is encouraged. So peer oversight and accountability is basically encouraged under self-regulation. This is fostering a sense of responsibility within the profession. This is to foster what we call a sense of of responsibility within what's called the profession. Foster a sense of responsibility within what's called the profession. How many points were needed? We have it already. Is that, do we have it? Have we given all the points? You responded yes if we've given all the points. Perfect, thanks. So the next question, which one is the next question? The next question. Question 5. Question 5. So 4 we did. So I say, in the context of tax compliance and advisory, the roles of a tax agent and tax representatives are different, yet they overlap. So the roles of a tax agent and tax representatives are different, yet they overlap. So I've been told that with the reference to the above statement, explain two distinguishing factor between tax agents and tax representative. What's the difference between tax agents and tax representative? That's what the question is asking. Tax agents and tax representatives. So tax agents, you cannot see me. Sorry. Tax agent. So what is the difference between tax agents and tax representatives? Is that where we are? we make sure we finish this. Is that okay? Do we make sure we finish this? What is the difference between tax agent and tax representative? Tax agent and a tax representative. Can you hear me? Respond to this. Tax agent and a tax representative. Tax agent and tax representative. Are we there? I hope we're there. So what is the difference between a tax agent and a tax representative? So the first difference stems on, we talk about registration, and what we call an appointment. The first comes on registration and appointment. The first steps on, so tax agent, and then we have your tax representative. So I'm saying that the first difference basically stems on registration. So an agent must be registered with the tax authority. Are we together? An agent must be registered with authority, and we call and licensed together. So that's true. An agent is registered with authority and licensed together, Lucy. An agent is basically registered with authority and licensed together. And is required before you're licensed, you must meet what's called qualification. You must meet the qualifications. So you must meet what's called the qualification. On the other side, when you talk about a representative is not registered by revenue authority. Are we together? Not registered. So this is a person, you can be a representative. You may not have even the qualification, but you can be a tax representative. Examples of accounting officer, is a tax representative. He may not have the qualification altogether. So not registered. This is not registered or licensed by what's called by tax authority. Are we together? So that is the difference between a tax agent and a tax representative. Do we know it today? Are we together? Are we together? Not registered. So this is not registered, hence not licensed. They say hence not licensed. I hope that is. The second is on scope. Scope. The second is basically on scope. In terms of the duty, the second is basically on scope. Are we together? So in terms of scope, if you look at agent, a tax agent has what call a wider scope. A tax agent basically has what's called a wider scope, of scope, since they carry out all responsibility. As a wider scope, since they carry out all responsibility. So a tax agent has a wider scope altogether. That's an agent. Then representative. Then you have the representative. So on the representative, we need to understand that representative has what called a narrow scope, since they don't carry out all responsibility. Narrow scope, since they do not carry out all responsibilities, all the responsibilities together. They have a narrow scope because they do not carry, but they also have a wider scope because they carry out wider, because they have what's called the wider scope, since they carry out all responsibility. Here you go, sir. So the last question is 5. Which one? Kuna yenye imebaki? Is there one that is still pending? So we've been told that tax amnesties are used by countries in formulating tax policies to encourage people to encourage tax compliance. In relation to the above statement, evaluate limitations of tax amnesty by the countries. Limitations of tax amnesty, limitations of tax amnesty, limitations of tax amnesties by countries, by the countries. So the essence of tax